All right, welcome. Today, we're digging into what you might call a good problem to have. Imagine a company's done really, really well. It's super profitable, and now it's just sitting on this huge pile of cash. The question is, what's the right thing to do with all that money? Let's get into it.
When you invest in a company, it's not really like putting your chips down on a roulette wheel, right? It's about believing in a business. But when that business hits the jackpot and starts generating tons of cash, how does that money, those winnings, actually get back to you, the shareholder? Well, that's the multi-billion-dollar question, and it's all about something called payout policy.
So, when a company has all this extra cash, more than it needs to run the business or invest in new projects, it really boils down to two main options for paying its owners.
Okay, so what are those two options? Well, first, you've got the classic cash dividend. This one's super straightforward. It's a direct payment right into the pocket of every single shareholder. If you own, say, 1% of the company, you get 1% of the total dividend payout. Simple. Then, on the other side, you have what's called a share repurchase, or you've probably heard it called a buyback. This is where the company itself acts like an investor and goes out onto the open market to buy back its own stock.
Now, for a really long time, dividends were pretty much the only game in town. But as you can see right here, that has changed in a huge way. Over the last few decades, share repurchases, that's the blue bars, have just exploded. I mean, they've become so popular that they often completely dwarf the total amount paid out in dividends. It's a massive, massive shift in how corporate America operates.
So how does a dividend actually get from the company's bank account to yours? It's a pretty specific four-step dance. First up, you have the declaration date. That's when the board of directors officially announces, hey, we're paying a dividend. Then, and this is the really important one for investors, you have the ex-dividend date. You have to own the stock before this date to get the cash. If you buy on or after, you're out of luck. The very next day is the record date, which is when the company takes a snapshot and says, okay, who are our official shareholders? And finally, the payment date. This is the good part, when the money actually shows up in your account.
Okay, so this gets us to the heart of the matter, right? If you're an investor, which one is better for you? Would you rather have a crisp dollar bill in your hand from a dividend, or would you rather the company use that same dollar to buy back its own stock? It sounds like a simple choice, but believe me, the answer is anything but.
And here's where things get really interesting. Brace yourself, because according to a Nobel Prize-winning theory, in a totally perfect world, it makes no difference at all. Seriously. A couple of geniuses named Modigliani and Miller proved that if you ignore things like taxes and transaction fees, you end up with the same amount of wealth either way. Let me show you how that math works.
All right, let's walk through the numbers. Look at the top row. We've got a company worth $1.1 million, and each share is trading for $11. Now let's say they pay out a $1 cash dividend. What happens? The company's cash goes down, so the stock price drops by that dollar, down to $10. But you now have a dollar in cash. So you have a $10 stock and $1 in cash. Your total wealth is still $11. Makes sense, right? Okay, now what if, instead, they do a stock buyback? The company still spends that cash, but instead of giving it to you, they use it to reduce the number of shares out there. Fewer shares means your slice of the pie is bigger, and the stock price stays at $11. So in both cases, your total wealth is exactly the same. It's like they're just cutting up the same pie in a different way. That's a really cool theory, right? But, and this is a huge but, we don't live in a perfect world. And as soon as you start adding in all the messy, real-world stuff, the choice between dividends and buybacks suddenly starts to matter a lot.
So, let's talk about why payouts really matter in the real world. Because as it turns out, market imperfections change absolutely everything.
Okay, so here's the first big reason it matters. These payout decisions send incredibly powerful signals to the market. Think about it. When a company raises its dividend, the leadership team is basically shouting from the rooftops, "We're doing great, and we're so confident about the future that we can promise this higher payment for years to come." But on the flip side, cutting a dividend? Oh, that's a massive red flag. It tells the world you're in trouble, and the market almost always hammers the stock for it.
And hey, don't just take my word for it. Look at what executives themselves say. In a survey, a staggering 94%, almost all of them, said they try to avoid cutting the dividend at all costs. And nearly 90% said their goal is to keep that dividend stream smooth and steady. Why? Because they know everyone is watching. They are actively managing these payments to send a signal of strength and stability.
All right, reason number 2 why the perfect world theory breaks down.
And it's a big one we can all relate to. Taxes. The government doesn't treat all investment income the same. The money you get from a dividend can be taxed very differently from the profit you make when you sell a stock, what's called a capital gain. And that difference can seriously change your final return.
Let's look at a concrete example of how this plays out. We've got two firms here, A and B. Before taxes, they both give you the exact same return, $112.50. But now, let's factor in the tax man. Firm B pays a dividend, and in this example, that dividend income is taxed at a pretty high rate of 40%. Firm A, on the other hand, doesn't pay a dividend. Its entire return comes from the stock price going up, a capital gain, which is taxed at a much lower 20%. And look at the result. Your after-tax income from the dividend-paying firm is way lower. This tax advantage is, frankly, one of the biggest reasons buybacks became so incredibly popular.
Okay, so all of this, the signaling, the taxes, it all feeds into this bigger idea, the payout life cycle. The way a company thinks about paying out cash actually grows and changes right along with the company itself.
And there is no better case study for this than Apple. For years and years, when Apple was in its explosive growth phase, it paid zero dividends, it did zero buybacks. Every single penny of profit was plowed right back into the company to design the next iPhone, the next big thing. And by doing that, they built this absolutely legendary mountain of cash. Just look at this chart. By 2012, it was over $100 billion.
But by then, Apple wasn't a scrappy startup anymore. It was a mature giant. Its growth was starting to slow down, and investors, well, they started looking at that giant pile of cash and demanding their cut. The pressure was just immense. As one business school professor put it so perfectly at the time, they have a ridiculous amount of cash. There was just no way they could possibly reinvest all of it.
And so, in 2012, the dam finally broke. Apple announced a massive plan to start returning capital to shareholders. It was a 1-2 punch. They started paying a dividend and launched a huge share buyback program. The initial size of that program, a mind-blowing $55 billion. This was the moment Apple officially transitioned from a pure growth company to a mature, value-returning machine.
So let's wrap this all up. What are the key takeaways? First, companies have two main tools to return cash: dividends and repurchases. Second, in a perfect theoretical world, it doesn't really matter which one they choose. But third, and this is the important part, in the real world, things like market signals and taxes make that choice absolutely critical. And finally, a company's payout policy is really a mirror. It reflects where that company is in its own life cycle, from a young upstart to a mature giant.
And that leaves us with a really fascinating question to think about. Today's tech giants are building up cash reserves that make Apple's 2012 pile look small. So are they just going to stick to the same old playbook of dividends and buybacks? Or will they have to invent entirely new ways to share that staggering amount of wealth with their investors? It's a question that will shape finance for years to come. Thanks for joining me for this explainer.